Thanks everybody for joining us today for our February Copperleaf Financial Town Hall. One of our scheduled town halls on sustainability this year. We're looking forward to a number of town halls specifically focused on sustainability. So thank you all for joining us today. My name is Michael Thompson. I'm partner and senior wealth advisor here at Copperleaf Financial. We're based in Williston, Vermont. Today our guests are Sam and Sarah Adams, global experts on the topic of sustainability. But before we get into our topic today, which is all about what's new in the world of sustainability and kind of where has sustainability come and where are we today, I want to first recognize Vermont Businesses for Social Responsibility, VBSR, and bear with me for a second with my technology. Sorry, everybody. I know this is good. Okay, thank you. So thank you to VBSR, Vermont Businesses for Social Responsibility, for helping us sponsor today's town hall. VBSR is a statewide business association of 700 members across the state whose mission is to leverage the power of business for positive social and environmental impact. They champion businesses as a force for good through education, networking, advocacy, and thought leadership. People are drawn to VBSR from many different backgrounds: students, entrepreneurs, policymakers, activists, sole proprietors, the largest employers in our state, and inspired individuals. What unites us all is VBSR's mission: a just, thriving, and transformative economy that works for us all. One of those important connections is the partnership between VBSR and Copperleaf Financial. VBSR is here today to show their support for Copperleaf Financial as a VBSR member and a values-led business in Vermont that's providing vital education that champions social and environmental impact through the power of businesses. So thanks to VBSR for sponsoring us today. And I want to share one more screen real quick because Sam is also the co-author of a book that we're very proud of, co-authored with our friend Larry Swedroe. And I wrote a foreword for a copy of the book that we have available. So for folks that are participating today, if you have some interest or don't have a copy of your Essential Guide to Sustainable Investing, let us know. We'd love to give you a copy. So, and thanks, Sam, for the fabulous book. The content here is unbelievable and really is truly an essential guide to sustainable investing. So once again, our guests are Sam and Sarah Adams. You guys have been champions of sustainable investing for many years and are truly global experts in this area. So I want to thank you for joining us. And I know we've got a lot to cover today, so I'm going to let you guys jump right into it and really start with, where do we stand? How do you want to walk us through this conversation about the current state of sustainable investing, guys?
Well, thanks for having us on, Michael. It's great to be back on the program. I am Sam. Obviously, I am the CEO and co-founder with Sarah of Vert Asset Management. We're a dedicated ESG investment management firm. And as Michael said, we've been doing sustainable investing for over a decade now and paying attention to it for much longer than that.
I'm Sarah Adams, and at Vert Asset Management, I'm Chief Sustainability Officer and co-founder with Sam. Just really excited to talk about sustainable investing with you all today.
So one of the questions we often get from sustainable investors and non-sustainable investors actually is what's going on with sustainable investing? What is the latest? How is it developing? And so we like to give people updates. And so we're going to give you a quick snapshot of what has happened in the last year or so in sustainable investing, what all the noise and fuss has been about. And then we'll talk about how things have changed in the last 5 years or so around the landscape of sustainable investing. And then we have some questions that are very common that people ask. And so we've teed them up in the hopes of generating some more questions from you as we go through the program today. So
Thank you. I want to add while you're bringing up your slide, Sam and Sarah, I want to mention we are recording this session, so we'll have it posted on our website in about a week, so sometime next week. And we of course invite questions. So if you have questions along the way, please enter them in the chat, and we'll get to them. Yeah, carry on. So what's the current state, guys?
all right.
Right. Well, pick up any newspaper, your local newspaper, even there might be some fuss about ESG, sustainable investing. Is it over a tax on sustainable investing, anti-ESG, or woke is broke? I don't know if you've seen these things, but certainly in the financial journals, the Wall Street Journal, Bloomberg, we're seeing this. And I think to some extent, it's a lot more fuss just in the media than it is really hitting investors or investment managers.
And in some respects, it's also a reflection of the success of sustainable investing. It's gotten so big that it now some of the more mainstream investment managers are feeling their market share being eroded from sustainable investing, and so they've launched some attacks.
Yeah, conventional investing that their market share is
But the good news is, if you're sustainably minded, it doesn't seem to be affecting the continued growth in sustainable investing. So here's a chart that shows by quarter over the last several years, the amount of money globally that's flowing into sustainable funds. Those are the green bars, versus conventional funds is the gray bars. And you'll see that the sustainable investors have been continuing to send money in, net positive flows into mutual funds and ETFs throughout these volatile markets. Whereas conventional investors, tend to invest a lot in the good times, and then they run for the exits and they sell in the bad times. Of course, this is the opposite of what you should be doing. And there are, of course, a lot of conventional investors that do market timing. There's a lot of conventional investors that don't have financial advisors that help them keep the discipline. But for whatever reason, that's a normal pattern that we see. Whereas the sustainable investors, they are more disciplined. They're still holding on, which is great for their financial future. It's also good for the future of people and planet, because as more money proportionally goes towards the sustainable investments and the sustainable companies, those companies will be rewarded for their efforts. So it's all good news from a cash flow perspective on what's happening in that regard.
And a lot of this over the I'm looking at, having sort of been doing this for a long time, Sam, the last 10 years certainly, and even the last 5 years up to last year, the inflows into sustainable investments, exponential growth, literally exponential growth. A lot of that, I think, historically was driven by institutions. Are we still seeing the flows? Big flows from institutions, or has it shifted more to kind of individuals or consumers?
Yeah, about starting 5 years before and previous, it was all the big institutions. I mean, 99% of the money was from, the California pension system, the New York pension system, the Norwegian pension system, the Japanese, these really big $1 trillion, hundreds of billions of dollar investments. And so the majority of those large investors invested early in sustainability and continue to do so because they see it as risk, right?
Yeah.
It was only later some leading financial advisors like Copperleaf and individual investors got access to this by more and more mutual funds that have been launched in the last 5 years. And so 5 years ago in the US, you could measure the amount of money flowing into sustainable funds, a couple billion a quarter. And then it went to 10 billion, and then it went to 20 billion a quarter. I mean, when you say exponential, you're absolutely right. 5 times more, 10 times more money flowing into sustainable funds recently than 5 years ago. It's really changed the landscape. And I think that's part of what we mentioned earlier, the backlash against sustainable investing. The conventional fund managers going, wait a minute, we need to defend our turf here.
Yep. Yep. Good. Thank you. That's super helpful, guys.
But there's even more evidence that it's becoming part and parcel of a broader set of investors.
Yeah, I mean, so the SEC is set out to protect the investor. And so ESG, social responsible investing, companies that are voluntary reporting out disclosures on carbon emissions, climate related risks, physical risks to buildings, your risks to regulations changing, giving you a carbon tax, essentially. The SEC is responding to this kind of market-led groundswell to say, okay, we need to put some parameters in place so it's standardized reporting across these different issuers, these different companies. An issuer is a company. What will be these questions that we will make sure every market participant that is large enough to file a report with the SEC each year? What are these questions that we need to ask? And we have these CDP and Task Force for Climate Related Financial Disclosures on the side here, because Carbon Disclosure Project is a nonprofit that started 20 years ago saying, okay, companies need to report their carbon footprint, their energy use, their emissions from that energy use. And then the Task Force for Climate Related Financial Disclosures was a kind of a follow-on to that, only about 6 years ago. That was really led by governors of banks of nations. For instance, the Bank of England, Mark Carney actually started it to say, hey, climate risk is actually a risk to financial stability of banks and investing and lending in our countries. We need a standardized framework. So these two instruments the SEC is borrowing from to create a rule that will come out in April of this year. It's just a way to show that some of this momentum is being caught up by and now being solidified by the regulator.
And it's going to bring on kind of collapsing together of some sustainable investing with conventional investing, right? Because as all companies have to report these ESG metrics, their emissions, their energy use, it becomes part of the regular financial reporting package. Sure. And so even regular investors, right, are concerned about climate risks. So it's great that the SEC is taking this on.
And I was going to say, as so well reported and documented in the book, Your Essential Guide to Sustainable Investing, so many of these factors are material and can have a material impact on performance and on the company. So, thank you, SEC, for finally catching up and starting to put something in place.
Catching up is the right phrase. Sarah and I lived in London for 10 years, and the UK regulator put these rules in place in 2012. So a good 10 years ago, they started requiring greenhouse gas emissions reporting from companies.
Yep. Good stuff.
All right, so that's our very quick shot of the landscape right now. We want to talk about how we got here, right? How did things evolve? And we're going to focus on this question that is very near and dear to our hearts, because when we set out starting Vert Asset Management, one of the big questions we asked is, if we shift, all this money from conventional regular investing to sustainable investing, are companies going to respond? Are they going to start behaving better towards people and planet in their pursuit of profit? So that's the question that we're trying to answer here in this review.
So this is a survey done by KPMG that they've been doing for over 25 years around corporate social responsibility reports, now known as sustainability reports or ESG reports, all of this voluntary corporate reporting on these sustainability metrics, this extra financial information that had a financial materiality to how the bottom line of the business, but just weren't caught up in the traditional financial reporting package of your balance sheet and your P&L. So 25 years ago, the largest 100 firms in 49 countries, that darker blue line, only 12% had a voluntary report that they would send out to their stakeholders alongside their financial package.
Wow.
Today, it's 80% of those companies report issue a sustainability report, track metrics on sustainability issues. The largest 250 firms globally, 96% of them track and report on issues that they believe are material to the running of their business that are quote unquote non-financial, sustainability, corporate social responsibility, kind of bucketing all those phrases together. So you can see that the market itself, those companies have really picked up the pace with this voluntary reporting, kind of demonstrating why there should be now a call for regulation. But is it really a market-led effort?
And it really changes the game for investment managers like us and investors like you. And let me give you a very specific snapshot of that. Our fund, the Vert Global Sustainable Real Estate Fund, invests in real estate companies, also known as REITs or real estate investment trusts. And when we launched the fund in 2017, of the largest 100 REITs in the US, only 60 of them did this voluntary ESG reporting. So think of my job as an investment manager. I'm supposed to sort out the companies that are being more sustainable versus the ones that are less sustainable and making distinctions between them. And I'm missing 40 of the companies, right, or more when you look at the smaller caps. I don't have a complete set of information on how companies are doing. Mm-hmm. Now, as of 2021, all of those 100 largest companies and most of the other smaller ones are reporting ESG. So my job is much easier, and we get much better information from the market as a result of this trend for voluntary reporting.
Yep.
So
go ahead, Sarah.
Oh, so just a little bit in more detail. So as a chief sustainability officer, I'm leading engagements with the companies that we invest in. We reach out to all of our portfolio now is 140 name holdings companies across the world, REITs, real estate investment trusts. And we reach out to them each year on a set of topics around carbon disclosure, climate risks, and other sustainability initiatives. Here on the left, you see carbon targets. More REITs have set carbon targets, meaning emissions reductions targets and energy use reductions targets over the last 4 years. So we're not going to say like it was our phone call that led to this, but it's definitely a cacophony and a growing cohort of investors, different types of investors. Sam mentioned the pension funds have largely been the biggest interested parties in their investments having a long-term perspective. And with that long-term perspective came some of these risks that we see further out, carbon-related, net zero-related risks. So we've seen a growth of 64% companies, 100 largest REITs start to set carbon targets. Within our own portfolio, 57 companies out of the 140 have set a science-based target, meaning that they have interim targets getting to 2050 to set reductions along a net zero pathway. And then on the right, sustainability goals. These are larger, broader topics, not just focused on your corporate carbon footprint, but on the water program or waste management or diversity, equity, inclusion initiatives around employee retention and attracting employees. We've seen 67% of the largest 100 REITs start to report this information out to their stakeholders as part of that sustainability reporting package.
So, so what we're seeing is, perhaps as a result of the inflows in consumer and institutional interest, companies are reporting more, significantly more, reporting on the sustainability risks. Which makes a lot of sense. We've got a question. I want to remind people, please, if you have questions, enter them in the chat, and we will get to them. We have set aside time at the end, but we can address them along the way as well. So We have a question from Bev. Accepting that ESG is a good thing, she says, show me the money. What does the data say on the impact of ESG investing on current returns, or is it all about minimizing future risk? And we can get to that later if you guys have something kind of queued up down the road, but I wanted to make sure we get the question out there.
Not surprisingly, Bev, you articulated one of the most common questions, right? That's very important. That's the two things is, are we performing well financially? Are we performing well on social and environmental issues? This slide is very specific to, we will talk about the performance on the financial side in a minute. So this is about the REITs in particular. I want to broaden out a little bit and go to companies around the world. This is a chart that shows of the largest 500 companies around the world, the Fortune Global 500. These is a chart of the different climate commitments, i.e. setting a decarbonization target like going to zero or net zero emissions by 2050 or by 2040, or cutting them in half by 2030, all different, those types of commitments. We're now at a point where 63% of those global 500 companies have set a major climate milestone or have achieved one already. Now, looking at that steepness of that curve, back in 2015, it was virtually none of those companies. Yeah. We are making huge progress on this. Now, some of these commitments are stronger than others. As Sarah said, those science-based targets, those are ones that are really locked in with interim targets. But you can see the massive change in numbers of companies that are taking this seriously and getting on board. We, of course, also have some work to do. There's 37% of these companies who have not set a major climate milestone, and we do need everyone to come on board with this, right? So,
yeah. Huge progress, though. Unbelievable. I mean, who would have expected in 2020 or 2010 or even 2015 this much adoption?
I mean, we should note, the Paris Agreement was signed in 2015. Mm-hmm. So I think that's why you see the big curve up. The Paris Agreement basically has galvanized the institutional and the government communities internationally to say, yes, we recognize that there is a carbon emissions, carbon meaning, all those seven emissions, methane, carbon dioxide being the most prevalent one, methane maybe the most potent, but recognizing this is causing some issue with our climate. Where prior to that, they're like, oh yeah, scientists are saying that, but we're not necessarily going to put our money towards or investments or our regulations to what a group of scientists are banging on about. The Paris Agreement really has changed that. And that's why you see such a momentum from 2015. Frankly, Mark Carney being the governor of the Bank of England, setting into place a momentum to say this is a risk to national financial stability, really kind of shocked those who are in offices. Yeah. Heads down in the numbers, the debt numbers that the country loans out, insurance, to say there is a real risk here, and what are we going to do about it, and how can we start to incorporate these risks into our financial reporting? Nice. So that's partly why you see that curve go up at that time.
Yeah, exactly right. We'd like to think that all of these people are, well-intentioned and warm-hearted and really care. We're certainly that most of them do. But the other part of it is they know that they're at financial risk here, and so they have to get going on this.
Yep.
All right, so let's get to those questions, and Bev, the very first question that you asked is about how's the performance been for sustainable investing, and what can we expect going forward. Now, here's part of what happened last year in those news headlines is that sustainable investments, for the first time in a long time, underperformed conventional investments. Not all of them, of course, but sustainable investments tend to have less in oil and gas companies than regular or conventional investments. And last year, while the market was going down, oil and gas companies were doing very well as the oil and gas prices shot up, right? So record profits to oil and gas companies. So they were one of the better performing sectors last year. And so the question that was in people's mind is this the end of sustainable investment outperformance? And are those sustainable investors going to run for the exits now that times are not good? Well, we already showed you the data on the flows. The money is still flowing into sustainable investments. They're staying put. And here's a chart that is one of the longest running comparisons of an ESG strategy versus a conventional strategy. This is MSCI, Morgan Stanley Capital International's 2 indices. ACWI stands for All Country World Index, and the yellow line is the conventional, the blue line is the ESG leaders, which is a subset, just the companies that are leading on sustainability. And you can see the line is very close here over, the now 15 years of data that we have. There was an outperformance of the ESG leaders regular through time, and then a little bit of underperformance last year. But overall, you're still okay. But the part of this chart that I like the best is that they're very close, right? There's not a huge distinction here. And if you look at the final numbers in the bottom right hand of there, the ESG leaders did 6.17% over this time period. The MSCI, the conventional one, did 5.63. That's a slight edge to the ESG, but statistically, that's almost a tie, right? That's very, very close over this time period. And so the takeaway that we have here is that you can invest sustainably without significant risk of underperforming to a conventional investment strategy. And that gives a lot of people comfort in embracing a sustainable investment strategy. Now, do we know what's going to happen going forward? No, of course not. We cannot predict these things. But if you have a well-constructed investment portfolio that's uses all the same parameters of modern portfolio theory and evidence-based investing that we all adhere to, then you're going to have a robust and stable investment experience like we've seen here in the chart.
Yep. And thinking about it analytically, and of course we don't have clear crystal balls, but if we think about sustainability or ESG as another risk metric, it certainly makes sense that investors and capital flows and performance may follow more favorably those companies that have lower risk over time in that way. Although one could take the contrarian view that I want to invest in the companies with the highest risk and the dirtiest companies I can find, because maybe that's where my long-term return is going to be. But I'm not sure I want to go down that path.
Yeah, that's the reason we don't know the answer. We're pretty certain that climate change is going to make things worse, right? Mm-hmm. And that the companies that are more polluting, the companies that are taking more environmental and social risks are going to have a harder go of it, right? They're going to be riskier companies. We already have good data that strong ESG performers are safer, more robust companies. But what you could have happen is that those really risky, like the really bad gross polluters, because their stock prices has been beaten up so badly because they're so risky, a lot of investors might pile in there and say, this is such a bargain, I'm going to take this, and their stock price might do well as a result. Now, so that's might happen. You get a super risky group of stocks might outperform a safer group of stocks. So our preference is let's hold the stocks that will be safer through time, okay? And as a group, they might outperform or they might be safer than the entire group. We'll take either one of those outcomes.
And the way I think about it is, if we know that the data show that at least over recent history, we're certainly staying the course and matching conventional investing, and in some time and maybe outperforming somewhat. then if I can align my values, if my values are aligned with a more sustainable approach, then why not? I'm not losing anything, and I may be gaining something in the long run.
Yeah. I mean, I haven't really included it here, but maybe it's worth noting for the audience. You know, there are these kind of corporate atrocities that have happened through time. You know, Love Canal in New York, building a school on top of, you know, an old chemical dump site. But having no transparency or insight to how what the company is doing relative to their community, their clients, their customer base. And these non-financial metrics have been the way to have more transparency. And so these companies that start to report more of this information, and it forms a whole ecosystem. You have MSCI that then builds a index like they've done here with ACWI and the ESG leaders around these non-financial metrics and tracking those companies who are being transparent in order to hold the companies accountable to their actions. So it can definitely be a economic value, and it values preferences, my personal preferences based solution, and they match up, but we have to have the transparency from the businesses.
Absolutely.
Yeah. I'm gonna ask a question, throw it out there that may be relevant. We do have another question that's helpful, so we'll get to the question in just a second. I'm wondering about with all the kind of the headlines and the industry pushback that you talked about in the beginning. I'm wondering if that's having an impact, and how that relates to greenwashing. Is greenwashing a problem, and what do you guys think about that? What are you seeing about that?
All right. Well, we can do the next one up was the political one.
Let's do that. Let's do that. No, I'm happy to do that.
The greenwashing, I think, is next.
Yeah. This sets it up, though. It sets it up.
That's good.
Well, question. This actually, I'm gonna jump in. It relates to the next question we have from Gail, which says, address political resistance to the ESG. Gail says, I've read that several states, including Arkansas, Missouri, and others, are currently proposing bills that would prohibit or punish firms that use ESG principles. So maybe you'll address that here.
Yeah. This is part of those headlines that we shared in the beginning. There's been this push coming from certain corners about that. And part of that, a large part of that, is a confusion over what ESG actually is.
Mm-hmm. So these are ESG metrics from this risk perspective. They can overlap with values, but from the risk perspective, you know, the CFA Institute, a highly regarded chartered financial analyst, a credential within financial services, a very conservative group actually, has finally put out a definition or like endorsed ESG in the last decade or so. But prior to that, we're very, very staunchly conservative in their financial views. They are defining E, S, and G from this risk perspective on the company, like how is the company's products, are they polluting the air, how they make their products, do they pollute the water in the process? From the social aspect, how are they retaining employees, or what is the customer satisfaction? These are some of those characteristics and those measurements that we're looking for in the markets to be reported out by the companies. And this is what forms the basis of non-financial ESG information. And then on the governance side, what lobbying alignments do they have? Is there political contributions? Is there a board separation of board and chair? Or what's their board composition? All this information helps to better inform the investor on what that company is doing, and make a decision on if they want to support that company with their investment or not.
This is why this is literally the first chapter in the book I wrote with Larry. Is there's a difference between ESG investing, which is about risks that really aren't that controversial. We'd all like to see more energy efficiency. We'd all like to see less violations of human rights. We'd all like to see less bribery and corruption. These parts aren't controversial. Now, when you start getting into expressing personal values, like I don't want to invest in guns, or I do want to invest in guns, or I don't want to invest in abortion providers, or I do want to invest in, those things can be political. And there's certain ways to invest with an agenda like that. But ESG is not that, okay? Sometimes it overlaps with people's agendas, but it is not that. Now, where this push is coming from that Gail was talking about is actually a very narrow set of people. It's funded by the same groups that funded the climate denying efforts, some old fossil fuel interests, and they took this small group and they started trying to convince a certain treasurers in a few red states to push back on this ESG. Now, some of that is a confusion over what ESG versus SRI is. And that's probably something we could clear up. But there's another part of it that's a bit more disturbing, and that is an attempt to really dig their heels in and protect the fossil fuel industries and say, you know what, we want coal to live on forever as a source of fuel because that's what we're used to doing, and we don't think we should stop doing that. Now, these people are putting the blinders on with regards to climate change, and we wish that they would pivot and say, yes, it's time for us to invest in transitioning from coal to solar and renewables and help the people that, brought us all those energy sources over the years, help them to pivot to the new technologies that are cleaner and cheaper and the ones that are going to be here for the future.
Yeah. So, I mean, even there's an ERISA rule, the Department of Labor says, okay, you can invest with ESG in mind in 401k plans, and that's just kind of passed or been allowed to happen after going back and forth over the different political changes in the last administrations. And these 25 state attorney generals launched a lawsuit against allowing small pension funds to invest with ESG in mind, specifically citing fossil fuel industry interests. So, I mean,
they have no chance of winning this. The big institutions, these large pension funds, are all in on using these metrics. And anytime if you said to me, you're going to make me invest in coal companies because why? Because you're the party of freedom and do what you want, but you're going to make me it doesn't make any sense, right? So this is not going to gain a lot of traction, but it is a good example of how incumbent industries fight back to protect their turf. Yeah.
Mm-hmm. And just really,
Are there ESG oriented lobbying groups other than, I mean, you talked about the kind of the dollars speaking for the institutional investors that are really committed to ESG and sustainability, but are there lobbying efforts or kind of fact-based organizations that are providing data to kind of counter some of the claims that are coming along from some of these political organizations?
Yeah, there's a lot. We're members in quite a few of them.
Yeah.
USIF is a big one, and they in fact helped just create a congressional caucus of representatives and senators who are pro climate change initiatives and those types of things. So there is, I think, a very concerted effort, and has been for many years on that front.
I think this is a systemic topic. You have groups like the Rocky Mountain Institute, who are a not-for-profit research and policy organization that help to inform the Inflation Reduction Act and some of the incentives around electric vehicle charging, on-site renewables for residential. So we're talking about investing in stocks that are traded in the secondary market right now, this conversation, but the ESG is happening from all different lenses. And so the Rocky Mountain Institute, they are bringing technology and policy expertise to the policymakers in Washington, D.C. on how to fashion the next bill around EV credits. So I guess we can't necessarily invest directly in what they're doing, but we, as a byproduct of that process and then that engagement and nonprofit work, we're getting that through the companies and the technology that they're bringing to different building owners. This process is too big for those, state AGs to stop. It's too big for the Republican side.
Those an interesting counter to their own efforts there is the fact that those are the states that actually have the most wind and solar power and are making the most money from wind and solar power. So there's this, this tension that, the economics will actually win out in the end, as renewables are cheaper than coal and oil and gas going forward. And so that if the markets don't persuade them through narrative, the markets will persuade them through price.
So maybe that's a good segue to my earlier question, which is, I think evidence and data have really been a positive impact in sort of helping to the growth of ESG and the growth of sustainability, but muddying that world is greenwashing. And so to what degree are you guys seeing greenwashing, and can you speak to that, or am I too early again?
No, you're good.
No, good.
We're more interested in answering the questions than going through our slides. So let's answer the questions.
The greenwashing is a problem. I think I guess our opinion is that over time, when conventional investors or conventional investment managers were releasing funds, they would start to rename funds around sustainability, ESG, impact, to capture those types of investors just on fund name alone, product name alone. So this is a survey put out by the US CIF, it's a self-reporting survey, but what they tried to do is understand how different asset managers were incorporating ESG sustainability issues, and to what extent did they do shareholder advocacy and then have some sort of overlapping strategy. Shareholder advocacy is where they're reaching out to the companies that they hold, not just investing with that lens. So over time, they did see quite a groundswell, kind of again around that 2015 time, the Paris Agreement in 2015. You see a swell up of ESG incorporation. And so in 2020, they were reporting that in the US, 1 in every $3 that's professionally managed had an ESG remit. That's a lot. That's mind-boggling. So this last release of their survey, they ratcheted down those qualifications of what it meant when you were an ESG incorporated fund, what it meant to be a shareholder advocate. And you can see this funny bar on the right. There's a lot less reported as ESG incorporation because they made the filter tighter to hopefully try to eliminate some of the greenwashing, or at least put on notice those fund managers that are renaming but not doing anything, to say that you're not going to get to be counted and you're skewing our numbers, and we need you to do what you say on the tin, and you're not doing that. But this is not the US SIF alone. This is following an other trend in the EU. There's the EU taxonomy, and the SFDR, which is around how funds define what they do, and that has really changed the way funds are being marketed there. Morningstar, just a provider and kind of an aggregator of what is in the market, also was tracking sustainability funds. They have also made their definition stricter to kick out those that were just had on the naming convention, but nothing to prove that they were investing that way. So they're holding all the oil stocks anyways.
And finally, the SEC and another proposed regulation is going to make U.S. mutual funds and ETFs, if they have sustainability or have ESG in the name, they will have to have 80% of their assets invested sustainably. Now, part of this, run up in the amount of assets that were claiming sustainability were greenwashers, right? They were fund managers who were trying to capture market share. They saw all the money going into sustainable investing. They said, "Hey, let's get on that wave." But a lot of them were also just conventional managers who said, that's an actual risk. That's a climate risk that I want to factor into my portfolio. And then they're like, I guess that's a sustainability consideration. So they kind of got caught up in the counting. Now that the counting's getting more, stringent or more clear, we'll be able to make better distinctions over what's, really focused on sustainability and what's just doing it as general risk management and which ones don't care about it at all, right?
Mm-hmm. Mm-hmm. Helpful. So clarity and transparency is evolving. It sounds like, and that's a good thing for the consumer and for the investor. Let's talk about impact and what kind of impact sustainable investing is actually having, or ESG investing is actually having.
I think did you want to go to a slide?
I thought maybe we should go to.
Oh yeah, okay.
Some of our slides.
Yeah. Well, we will go to an example of our engagement, and Sarah will talk about this as an example of how lots and lots of sustainable fund managers are reaching out to companies and trying to get them to improve their behavior, right? So there's the money moving, but then there's also, I guess we could call it the bully pulpit that we're given as the fund manager. For all of you invested in our fund, we represent you at these company meetings.
Yeah, so on the engagement side, we engage with the companies that we hold every year. They tend to be around climate-related topics because we're invested in real estate, and from a financially material perspective, a building can contribute to climate change, or not contribute, stop contributing to climate change by reducing their energy use and subsequently reducing their emissions. That both on the bottom line saves the building owner money, and it also can save the tenant money. And so there's the financial incentive. So in 2018, we asked people to report to GRESB and to the importance of like-for-like emissions reporting year on year for the investor to be able to track. This is all around transparency. Can you please report this information out? This was built on climate risks and the Task Force for Climate-Related Financial Disclosures that ask companies to have a very strategic look into how they're taking into account climate risks, physical risks, and those regulatory transition risks from their governance. Like, is their board aware of it? Are they involved? Is there a committee? What is their business strategy? And then the metrics that they're tracking that for. So over time, we've seen an increase in companies wanting to report this way, coming to speak to us about this. In fact, last week I was at a conference that was dedicated to net zero real estate, of other real estate providers, private equity technologies, how can we help the building owner reduce their energy use? These are the things that weren't happening 5 years ago. That is the kind of the proof in the pudding that this is happening.
So there's when you invest sustainably, you get into a fund or that the sustainable managers managing, they should be or could be doing these engagements on the investor's behalf, and you see real results. I wanted to give you an example. One of our favorite examples, because everyone knows the Empire State Building. The Empire Realty Trust did this energy retrofit all the way back in 2010, reducing the energy of the building use by 38%, which is the effect of taking 20,000 cars off the road in terms of emissions reductions. This is an amazing result. It didn't cost that much money. It's also saving them money. And if you can imagine this story being repeated for building after building after building, that's what we're seeing now. And you don't see that just in real estate, you see that in other parts of the market as well.
So you guys are making a really important point. And I want to make sure it's not lost on our audience. We have a smart audience, so I'm sure it's not, but sometimes I think in pretty simple terms. And what you're talking about is really the power of how you guys, as specifically as fund managers in this case for the Vert fund, can speak for investors that are investing in the fund and be advocates for the mission of the fund, and go out there and actually engage with these companies that you're invested in on our behalf as investors to make sure that they're reporting and to influence their behavior moving forward. It's so tangible, and I'm not sure that many consumers or investors really recognize how tangible that impact is and how tangible it can be as an investor in a fund to actually have an impact with these individual companies, because you guys are meeting with them, you're asking questions of them, and on behalf of your investors, trying to make sure you're pushing the mission and the vision of the fund on behalf of investors to improve sustainability with those companies. I think that's so important and can really get lost in the sort of nuance of sort of hands-off investing. I'm not sure we see that every day.
Yeah. There's a question from Bev again on
go for it.
Whether ESG is a monolith. We seem to just call it ESG, and she asks, is it possible for a company to be strong on S and G but weak on E, for example, or strong on E and poor on S or G? Is there a term for this? I don't know if there's a term for that, but it definitely happens, right? There certainly are cases of this. And in general, real estate was largely focused on the environmental side for a long time, because that was what there was numbers around that, and they could immediately see money drop to the bottom line if they reduced energy, like in this case. So these were easy things to get past the CFO and to prove to investors made sense. Now we're getting more S things that are becoming popular because people are worried about indoor air quality. They know that it makes the tenants more productive. And we see all the time companies that are excellent in one category and really falling short on another. You know, a lot of people talk about Tesla being a poster child for that. And that is what makes sustainable investing complicated. It also what makes sustainable ratings or ESG ratings something we don't recommend you use. This is one of my favorite charts. I know it just looks like a scattershot, but it's just one ESG rater versus another, MSCI versus Sustainalytics. If they agreed on companies, this would be all these dots would fall in a diagonal line. But you see here, there's companies that MSCI rates in the high 90s, and at the same time as Sustainalytics is ranking them in the teens or lower. There's no agreement around this because of this issue that Bev asked about. One rater rates environmental issues more important than another, and those types of things. So at the end of the day, you don't want to use ratings. You want to use a robust investment process and focus on the metrics that are important to you and important to the companies. And so this is one of the criticisms that you hear about ESG investing that we don't think is valid. We think that just like we don't use star ratings when we pick mutual funds on financial performance, we have more robust ways of choosing investments. Same thing here. And part of our role as engaging and investing is when we see a company that's great on an E issue but not great on an S issue, is to point that out to them and ask them difficult questions about it.
Yeah, and the I don't know about you guys what you find, but not being up to my eyeballs in it day to day like you guys are, I would imagine that the G might be the toughest one maybe to uncover, but I don't know.
I think G is probably the most well studied across even conventional investing, but it goes along. It's most well defined, corporate governance actions, the separation of board and chair.
Yeah, I guess that makes sense. Yeah.
But there are some issues around board composition that fall more in an ESG lens than a traditional type of investor. So even, with our sub-advisor, we would rate, there's maybe this is getting too into the weeds.
I think so.
Okay.
but
I think
composition,
I think as a social issue and the governance issue has cropped up in the last 5, even last 3 years more concretely, and having diverse boards and women on boards has been an issue more from a sustainability side, but it has bled into the conventional investing.
The tough part, Michael, is that we can get more diversity, we can get more independence, we can get more broad skills in there, but we really can't look into the whites of their eyes and see if they're committed to sustainability or not, right? So we have to look at their actions, like, do you have a climate policy? Do you have these decarbonization strategies? Are you making the company do that? And we can only judge them by their actions and their policies. I would like to, though, be able to, sit down and have lunch with them and ask if they really believe it or if they're just phoning it in, right?
Yeah. Well, we have a few minutes left, so maybe we can touch on what you guys see as the future of sustainable investing and kind of what's your crystal ball say about where we're going or where the industry is going. Where's all this headed?
Well, there's a couple of things you say that there's in the U.S. anyways. We know this is the case in Europe, but in the U.S. now, surveys show that most investors, particularly younger folks, but even older folks, are interested in sustainable investing. Most Americans are concerned about climate change and want to do something about it. Over 75% now. So we think the demand for sustainable investing will continue to grow because not that amount of money is invested sustainably yet. So that's one thing. The second thing is conventional investors will be forced to deal with ESG risks because they are material, right? So even if they're not going to brand themselves as sustainable or what have you, they're saying, I have a building in harm's way. It's in Phoenix. It's going to be hotter. It's going to be drier. I have to deal with that, right? Regardless of whether I'm sustainably minded or not, that's a fact of life going forward. So conventional investing will start developing some of these things as well.
I mean, maybe there'll be different names. Maybe it won't be ESG. I historically really thought that ESG was a great bridge because we had corporate social responsibility and the social aspect really focused on the S. And then people would say, what about the environment? And sustainability phrase started to be used with investments. And ESG really bridged those two together. But maybe it will be, we're hearing future-proof or just resilience.
Regeneration.
Yeah. So these phrases to really drive home what we're trying to plan for the future of people and planet, like resilience, future-proof, right? But that everyone can get on board with. And so we decided to rename it.
Now We are fans of markets. We think markets are incredibly powerful, and capitalism, for all its flaws, is probably, after gravity, the strongest force on the planet. So it's very comforting parties in the world. It's very exciting for us to see that the money continuing to flow in ever greater numbers, and the data continuing to get better, and companies responding more and more, because that is what we want the world to do, is to head in a more sustainable direction. And if you have those three things going for you, it looks like it's going to continue to happen.
Yep. Thank you, guys. I want to thank Sam and Sarah for joining us today. Great discussion on kind of this current state of sustainable investing and where we're going. Really appreciate it, guys. Also want to shout out again to VBSR. Thank you for helping us sponsor this series this year on sustainable investing, and invite everybody to join us next month in March. My guest is going to be Adam Barch. We're going to talk about when is it time to update your estate plan. So estate planning is our topic for March. So thanks again, everybody. Have a great week, and I'll see you again next month.